All right. Hello, everybody, and thank you for joining us. I'm Tyler Resh, Chief Growth Officer at Alpha Summit, and I'll be your moderator today. We're going to go over a real look into what Alpha Summit is and provide some insights about Alpha Summit, why it exists, how we think about building investment solutions, and what's actually on the platform today. And what I want to do is introduce you to today's speakers. Let me introduce you to the two people you'll hear most from today. First is Maz Esmailbeigi, and Maz is our founding partner and chief investment officer. Maz has spent his entire career building portfolios for high net worth families, and he chairs the investment committee. Maz is going to walk you through the origin of Alpha Summit and some of the details of the platform. Welcome, Maz.
Welcome. Thank you.
And Steve Dymant. Steve is our deputy chief investment officer. And among many things, Steve runs the platform, including our private alternatives lineup. And he's the person closest to how the funds are created. Glad you're here, Steve.
Thank you, Tyler.
And as I mentioned, I'm your moderator. I'll be moderating today, which mostly means that I'll keep us on time, make sure your questions get answered, etc. Maz, I'll hand the story over to you shortly, but first, let me set the stage. With respect to how we're going to spend our time, we're going to start with why Alpha Summit exists, which is a very important part of this session. Then the investment philosophy that follows from it. Then we'll go into the details, the options-based SMA platform, the private alternatives platform, and then we'll close with Q&A. It's roughly 45 minutes of content with some questions. If we run long on the questions, we'll stay on and address them. I think one important part of this too is just a word on who this session is built for. It's designed for professional allocators, registered investment advisors, family offices, institutional investors. And the important part is this is educational only. Nothing you hear today is an offer, a solicitation, or investment advice. So with that, let's get into it. I want to start with a picture of how most of this industry actually works because this contrast is really important. The traditional asset management model is this. It runs in one direction. A firm creates a product, then it goes and finds buyers for that product. And to be fair, that model has produced a lot of good investment solutions over time. But notice what's missing. Typically, nobody creating the product has to sit across the table from the person that ends up owning the product, aka the client. And Maz and Steve have both spent their entire careers on the other side of that table as the buyer. And that's what has informed everything we do here at Alpha Summit. And so when we look at this slide, the important sentence that I'd like to underline is the one thing I want you to take away today, which is Alpha Summit was not built by product manufacturers. It was built by wealth managers, by the very people who have spent decades serving high net worth individuals and who have had to solve the problem for real clients, real names, real families, and their related tax returns. Every solution on this Alpha Summit platform was built for our own clients at SteelPeak Wealth before it was even offered to anybody else. So let's look at our approach. This is the sequence we run. We start with the investor problem, something a client is facing that the standard investment manager doesn't necessarily solve for, or they've made it so obtuse, it's really difficult for the investor to get access to that, or it just doesn't necessarily specifically apply to that investor's problem. Then we design the solution around that specific problem, and then we build that strategy that delivers it. The strategy is built only after we fully understand the client's needs. And so let's bring Maz into the conversation now. And as we think of the demands of what clients require from their wealth manager, as well as the complexity of the offerings that are out there, not to mention the macroeconomic trends that are happening, this has become a very competitive landscape. So Maz, as I bring you into the conversation, I would ask, what of these 5 needs that you see over on the right-hand column of the slide are most advisors talking about? And maybe touch on what's changed over the last few years, given what's happening.
Thank you, Tyler. Of course, openly, when I started in this career 25 years ago, it was a far different landscape than it is today. Just the fact that we have information readily available to us at the tip of our fingers is far different than how it was when I started this career. So today's landscape is far more complex than ever before. And quite frankly, investors are far more complex. They expect more from their advisors. They expect more from their firms when it comes to investment solutions. So when it comes to client needs, the information on the right-hand side of the screen, quite frankly, all of it is important to clients nowadays. It's no longer, just give me return. It's really a client looking at their portfolio in a very holistic manner and saying income, tax efficiency, protection during difficult times of the market, strategies that aren't correlated to the market. Give me institutional type investments that normally are only available to extreme high net worth family offices. They want those same capabilities available to them today.
Yeah, that's helpful. And, that really gets us to sort of, where we focus. And so if you take each of these problems in turn, what, Maz, are you hearing from clients and what did we build at Alpha Summit in response?
Yeah, as you correctly stated, our vision really came from the platform of being an advisor, right? So 25 years in this industry, understanding what clients are looking for and tailoring solutions to those needs and those problems. So whether it's income, taxes, alternatives, or making portfolios, quite frankly, just more efficient, we've focused on different solutions that will generate cash flow on a monthly basis. We want to make sure we're mindful of what the net result is to the client once taxes are taken into consideration. And as I indicated earlier, having strategies in the portfolio that are unique and different, that aren't traditional in the sense of alternatives. And then lastly, being able to scale as an advisor. One of the things, quite frankly, that was challenging earlier in my career was not just servicing the clients and making sure the reviews are done and the portfolio is being managed correctly, but being able to service and being able to scale my service and bringing solutions to the table allowed me to scale the practice. So that was paramount, and we believe we put something together that's very unique that allows advisors and firms to do that.
It's a perfect segue to, what has been produced as a result of all of what you just said. And it really stands as what you see on the slide here, which is two platforms. On one side, you have the options-based SMAs, where, cash flow and management is delivered inside of an SMA at the very account level. And then on the other side, you have private alternatives, which are, like you said, institutional access to private markets, curated and diligenced by the same investment committee that runs our client portfolios at SteelPeak. And so this is going to be what we talk about today, the options-based SMAs and the private alternatives, because this is the Alpha Summit platform. So let's unpack this a little bit more. And so what you see on this slide is obviously a lot of solutions. And so there really are 5 private funds, and then there's one SMA family whereby we show 5 SMAs. And maybe you can help us walk through this slide, Maz, in particular.
Of course. And openly, I'm going to let my colleague Steve dive in much more in depth regarding our 5 funds that are proprietary and private to SteelPeak, or excuse me, to Alpha Summit and to other advisors. But again, the goal behind the 5 funds was to produce something that was going to be unique and different, to produce strategies that generally clients would not have access to, and produce solutions that would be very rewarding to the end client. And then certainly, as I mentioned earlier, when it comes to separately managed accounts or SMAs, come up with strategies that add value, not just help clients and advisors scale their practice, but have solutions that are different in the sense of achieving goals and objectives that clients need, but are very difficult to achieve without it being extremely laborious to the advisor.
That's great. And that's what we'll start to unpack now as we look at what we want to cover today. And specifically, let's start with those SMAs. And, you mentioned that they're options based. And I think, there's a little bit of a misconception that I'd like you to address head on. And perhaps it's this misconception that options are speculative, they're complex and they're risky. They're certainly complex. But how about this notion that options are speculative. Where does that come from, and where do most advisors and or investors get it wrong?
That's a great question, Tyler. And if I had to take a guess, and this is purely a guess, I recall again when I was early in this career during the dot-com bubble, many investors were using options to speculate on where the market was headed. And as we all know how the dot-com bubble ultimately ended, those investors learned a very hard lesson. So certainly there is a segment of the derivative world or options world that can be speculative and complex and risky. And I can tell you at Alpha Summit, that's not what our focus is. By definition, our strategies actually make a portfolio slightly more conservative by generating income, reducing risk slightly, and being able to customize portfolios. So yes, options can be scary, but we do our best to paint a picture at Alpha Summit that allows the end client to realize they're getting rewarded for owning good companies, not simply through appreciation, certainly, and hopefully that's part of it, but through generating a meaningful level of income as well.
Yeah, that's great. So let's unpack the platform more specifically. I'd mentioned that there are 5 funds readily available today on via Alpha Summit, and there are others that certainly we can give access to. But give us the one-line overview of each of the 5 that are on the screen here, if you would.
Sure. The first thing I'll point out is that you'll see the word dynamic in front of each individual model or strategy. That's just our way of indicating at Alpha Summit that each one of these strategies, we're implementing an overlay of a cover call writing strategy. So whether it's Dynamic Alpha Growth, Dynamic Alpha Value, Dynamic Disruptors 20, Dynamic Buyback Achievers, or Dynamic Global Equity, we're implementing a 30-day option strategy on top of the underlying position to generate meaningful income while the client is waiting for that appreciation to occur. What we'll focus on is not just income, but allowing clients to participate with some upside to those underlying positions as well. So it allows us to hopefully get best of both worlds, participate in some appreciation as well as generating some meaningful income. And as you can tell by each name, each strategy has a very unique focus and investment policy statement. So certainly growth, we're looking at strategies that are within the growth sector, the NASDAQ 100, Dynamic Alpha Value, as the name alludes to. Again, we're looking at value companies, more dividend paying companies, and so forth.
That makes sense. And so let's look at that dynamic alpha growth. I'm going to put up on the screen here just a little bit of information about that particular strategy. And maybe you can just share with us, the why 16 names, why equal weight, why the NASDAQ 100, and then maybe perhaps walk us through that call writing program. You touched on it a little bit, but maybe a little more detail on what determines the selection of the strike selection and, how much that portfolio gets written against it.
I appreciate that, and I appreciate the opportunity. So first, I will say that all of our strategies are GIPS verified. So that's very important to know. So when you're looking at our fact sheets and you're looking at historical returns, you can feel comfortable knowing that those returns have been verified and audited and are true to what we're stating. Then I'll add that when you're talking about dynamic alpha growth, as you see on the slide, we're looking at 16 positions, each equally weighted, because we're not trying to necessarily overweight or underweight any one specific investment. But what we're doing is looking at a specific sector of the market, in this case, the NASDAQ 100, and we're looking at large cap growth names that we feel are going to be performing well over the coming months and quarters and hopefully years to come. We're implementing a 30-day cover call writing strategy, so very short in duration. And as you can imagine, this is very proactive when it comes to the management of the portfolio. And we're generally selling out of the money call options, going out anywhere between 5 to 10%, depending on the volatility of the underlying position. Now, I don't want to give up too much of our secret sauce, as they say, but we take many different things into consideration when we're deciding how much income to generate and how much upside to allow for that underlying position. In general, and on average in the portfolio, we're generating about 0.5% in cash flow a month with an average upside cap of about 8% per position. Now, it's very important to understand these numbers because when you're generating roughly 0.5% of income per month, that's obviously equal to roughly 6% per annum. So now you're looking at names like Amazon. You're looking at names like Meta. You're looking at names like NVIDIA that pay little to no dividends, but now you're able to reward clients with meaningful cash flow while they're owning these good companies and hopefully seeing appreciation over the long term, as well as hopefully some upside over the short term. So we're rewarding clients for owning good companies and being patient to see that appreciation with that monthly cash flow.
That's great. And I'll just go back to the slide here where it shows sort of the roster of the SMAs on the platform today. And like I was alluding to, we'd only touched on the one on the top left, Dynamic Alpha Growth. There's others, and there's a similar story and conviction behind each one of these. And so we'd invite you, if this does, speak to your clients' needs and something that you're interested in, we invite you to have a deeper dialogue with any of us to speak more about some of these other strategies that are on there. So with that as a backdrop, as Maz appropriately alluded to, some challenges can't be solved in the public markets, and so they require private markets. So let's look beyond the SMAs as we look at the Alpha Summit platform, and let's talk about the alts. And I think that's one way to sort of frame this up is to think about how this industry has evolved, thinking about alts. And I'll keep you on the stage, if you will, Maz, just to talk through this evolution of portfolio construction. You've obviously seen, where we were with the 60/40 portfolio and where we are today. Just explain to us what we're looking at here. And, for an advisor that's sitting at zero alternatives today, what's a realistic starting allocation?
That's again, very meaningful question, Tyler. I'll keep aging myself. Again, going back early in my career, roughly 25 years ago, when I first started in this industry, I was taught that, look, a traditional 60/40 portfolio, 60% in stocks, 40% in equity, perhaps 1 or 2% in cash here or there, would be very rewarding and meaningful to clients, and you were diversified appropriately. So when the stock market was performing poorly, your bonds would hold up the portfolio, and the other way around, should the bond market be underperforming and the equity markets do well. And I can tell you in the last 25 odd years, we've seen many scenarios that, quite frankly, that has not been the case. So whether it was the tech bubble, the financial crisis of 08, 09, the challenging market of 2018, or the most recently challenging economic environment in 2022. If we go back and look at 2022, if you had your investments in equities, you performed poorly. If you had your money in fixed income, you performed poorly. And quite frankly, if you kept a large allocation to cash, even though you didn't see the value of your cash go down, you lost purchasing power because in June of 2022, inflation was close to 9%. So being diversified in those three traditional asset classes has not been truly a diversification. They've been correlated many times in the last 25 years. So when you're talking about true diversification, you do want to add alternatives. And many of us who have done studies, we've seen large institutions, pension plans, endowment plans, specifically add alternatives as an asset class because it does do something and perform very differently if you're using it correctly than traditional equities and or fixed income. So to your question of how much of an allocation should an investor have in alternatives, it's really an open-ended question. It's very hard to answer that, no different than how much should an investor have in equities or fixed income. It has to do with many different questions, obviously the appetite for risk and volatility. But in our humble opinion at Alpha Summit, all investors should have some allocation to alternatives.
Makes sense. And I think, the historical references definitely accentuate that point. So let me pick this up because this slide here really describes the problem that we hear constantly in advisor conversations. I think every advisor that we speak to agrees now with, the thesis that there should be some allocation to alts, or certainly many more do than ever before. They believe in the allocation, but very few have actually made it. And there's really three things that stop them. Mostly because what you see on the screen, access, diligence, and building is a full-time job. The managers that are worth owning are frequently opened and closed. Minimums are written that are difficult to get access to. They're not really for a single client relationship. The underwriting is tricky, as I know both Steve, you and Maz can attest to. And there's a lot of diligence that goes into reviewing track records and the teams behind who's running these funds. And then implementation, the subscription documents alone are difficult. So I think the plumbing of all of this makes it hard. And so again, that's why Alpha Summit exists, and it's really not a question necessarily of why most advisors don't allocate. It's really around how they would allocate, and what's stopping them is capacity. So Steve, let me bring you into this conversation at this point and talk about our alternatives platform. As Maz alluded to, you are sort of closest to all of these solutions, and maybe as a jumping off point, you can share with us what's on the alts platform. Give us sort of a one-line description of these before we unpack each one of them, and then we want to also cover some of the gaps that you're trying to fill. But as a starting point, share with us what we have on tap.
Sure. Thank you, Tyler, and Maz as well. And as what's already been said, when we think about building alternatives at Alpha Summit, it is about finding those strategies or asset classes that we think are very beneficial to our clients and building it in such a way that they can get access to those strategies, that they can be in a situation where those strategies will provide ballast to their portfolio, reducing volatility, but at the same time, providing attractive returns and thereby being a very needed and necessary part of the portfolio and driving returns that are not highly correlated to the rest of their holdings. So to your point, Tyler, we have built 5 different private offerings already. Each has its own goal and place within a portfolio. And the ones that are currently open, I'll list first, and then I'll talk about one that is closed. But our Goal Line Growth Fund is a fund focused on the sports ecosystem to allow our clients to get access to that with one point of entry. We have a long short fund, which again is meant to provide ballast to a client portfolio, where most clients are long only various asset classes, including equities. And this is meant to provide an uncorrelated return with more diversification. Our Alpha Summit Tax Optimization Fund, which is built to provide not only attractive returns with an equivalent benchmark to the equity markets, but also focused on what the clients will receive after tax. So it's not just pre-tax returns, but it's after-tax returns. We then have our own Alpha Summit Strategic Alternative Fund, which is meant as a one-stop shop for all alternatives, where we have multiple managers and multiple strategies in an interval fund. And then finally, our Capital Opportunity Fund, it's now closed to new investors. We are now starting to harvest some of the gains in the portfolio, but that is a private equity fund that was meant to take advantage of both early stage and late stage companies.
That's great. Thanks, Steve. Okay, so you had me at sports. You mentioned something about sports, and I know what it is, but for those that are on the call or listening to the replay, let's dive into this world of sports. Why do we have a sports-themed investment fund?
Sure. And to me, this is one of my favorite funds to talk about. Being a sports fan myself, I typically would sit on the sidelines because I was not, like many of you, a multi-billionaire who could afford to buy their own NFL team or NBA team. So what we decided to do at Alpha Summit was to look at the landscape within investing in sports, taking advantage of scarce assets and the opportunity for our clients to not only invest in the sports ecosystem, but to be in a situation where they could see uncorrelated returns that were very attractive, that historically had been only the place where billionaires could play. And what we found was, while our clients were not able to write, 200, $300 million checks to get access to certain leagues, we could actually create a fund that looked like a multi-asset, multi-strategy portfolio, allocating to what we thought was best in breed in terms of underlying managers, and take advantage of the four verticals within the sports ecosystem. So we'd be invested in teams and leagues. Again, think the NFL, NBA, Major League Baseball. But because of the structural tailwinds in the sports ecosystem, media contracts, right? The growth of content away from regular TV. You were in a situation where merchandise sales, ticket sales, all of these structural tailwinds are providing a tremendous lift into the sports ecosystem, allowing investors in our sports fund to get that appreciation with limited to no correlation to the public markets, and be in a situation where they could benefit from the growth of sports as an asset class, but also, again, very attractive risk-adjusted returns that is a complement to their typical fixed income or equity portfolios.
Yeah, that's great. I'm gonna forward to the next slide, but I want you to sort of unpack, if you will, this low correlation claim, because that gets claimed often in the world of alts. But maybe share with the group this notion of how sports truly is, perhaps uncorrelated at its core.
Sure. And I'll talk about two examples, Tyler, because you're exactly right. One of the biggest selling points about this asset class is that it doesn't move with the public equity markets or even fixed income. And if we think about a few, events that has occurred that people look back to and talk about the movement in the equity markets, think about when we had the tariffs that were announced in April of 2025, and the public equity markets traded off 3, 4, 5%. Well, I can assure you that the Dodgers or the Yankees, the Dallas Cowboys, their value did not change overnight because we had tariffs that were being introduced. Or even when we've seen the conflict in the Middle East, again, these asset classes do not seem to be impacted by geopolitical events. They're not impacted by events that we see in the equity markets. They seem to be insulated because of the tailwinds and the scarcity behind these asset classes. So we like it as an alternative investment for our clients and through the Alpha Summit platform, because it tends to provide exactly what we're looking for: low correlation, very attractive returns, and a situation where our investors can access it through one investment versus trying to find 6, 7, or 8 different underlying investments that they'd have to diligence, they'd have to allocate a lot of capital to. This is one-stop shopping in the sports ecosystem.
That's great. Yeah, I love that story. It definitely resonates as a sports fan for me as well. And I think this next slide also resonates because it's a fun one to look at, because a lot of these names or logos on the bottom we recognize, but there's a few on there that we don't. So maybe talk us through. You had mentioned the four sectors and the what they represent, but walk us through the portfolio and maybe pick one or two investments and tell us why they got through the process and are in the portfolio as it stands today.
Absolutely. And as I mentioned, we're investing across four verticals within the sports ecosystem, and you can see them on the page. The first is teams, leagues, and franchises. And that's the largest portion of the portfolio, between 60 and 70%. So think about teams in the NFL, the NBA, Major League Baseball. But we're also investing in women's sports, women's basketball, women's soccer, right? And then we're also going to some newer leagues, such as pickleball or bull riding or sailing. We believe that is going to be the beta for our investors into the sports ecosystem. But there's also a lot of opportunity for alpha, which is sports technology, media and entertainment, and real estate. And for us as portfolio managers, as allocators, we believe a diverse portfolio across all four verticals will give investors the best risk-adjusted return and be in a situation where, again, they get the tailwind associated with sports, but the alpha by some of the underlying investments. And as you can see across the bottom of the page, some of those are ones that we're very excited about. And I'll start with the Buffalo Bills, who are on the left-hand side of the page. Our investment in the Buffalo Bills is not only owning a small piece of an NFL franchise, but as part of that transaction, we also own a piece of the stadium. So we're getting the opportunity not only as teams overall go up in value in the NFL, but also the real estate play, right? Another example, and that's right below that, is the what will be the Las Vegas A's. The A's are moving from Oakland down to Las Vegas. We'll own a piece of the team. We'll also own a piece of the stadium. And we believe the tailwinds across sports in general will allow these assets and other assets to continue to grow. And then last but not least, if you're someone who lives in the LA area, to the far right on the bottom of the page is Cosm. Cosm is an interactive venue where you can go and watch live sports. You can also take into other account other things that are going on in that venue. Think of the old planetariums that we used to go to, but now it's an immersive technology. And that is a real estate play as well as a tech play. And we believe as the portfolio grows, we have over 50 underlying investments today. Our investors are benefiting by the fact that they don't have to write a $100 million check to get 50 underlying investments. They can come in as a smaller investor and get access to every underlying investment within the portfolio.
Yeah, very cool. I think it's really interesting what you and the team have created here, and it's definitely been a fun one for us to talk about in terms of getting interest and getting advisors and their clients into the fund. So great stuff. And as a sports fan, I could leave this page up all day and we could sort of depict all these different logos and the other ones that are behind all of them. But in the interest of time, let's shift gears a little bit and let me help us appreciate a different problem that your team, Steve, has solved for, which is really the question around what is the biggest expense in a portfolio. And I think, if you ask the question, what is a client's largest annual expense? Almost everyone will bring up fees. They'll bring up, the fees that are charged in the portfolio. But the reality is the fees get disclosed. They're benchmarked, they're negotiated, and in many cases, they're even compressed. And so, in fact, as an industry, we've spent the better part of the last 2 or 3 decades driving those fees down. And so when you look at a high tax bracket client, fees aren't necessarily the largest cost. It's taxes. And it's really not even close if you look at some of the data. The drag that it has on a standard portfolio, it frankly it compounds just like the returns do. And so it's largely been absent for the way performance gets reported. And this is what tax optimization and the Alpha Summit Tax Optimization Fund is all about. So let me pull up the next slide. You can walk us through this, Steve, and then we'll get into the details of the actual fund itself.
Sure. No, Tyler, I think that makes a lot of sense. And when investors think about investing in various asset classes, right, to your point, they don't think about the after-tax return for themselves. They think about the pre-tax returns. And yet we all try to put money into deferred accounts to allow that money to grow and compound before taxes are paid. We are doing the same thing here at Alpha Summit. We are looking at investments across the public markets, but in a way where we not only focus on the pre-tax return to get that as high as possible, but also what happens after tax. Because again, if you don't get to keep the money, it doesn't do you that much good, right? You want to be able to generate high returns that fit within a portfolio, but keep as much as you can. And that's what we're doing.
And the data supports it, right? A slide like this shows exactly what you see. And now, obviously, this is illustrative purposes, but you can apply any client portfolio to this same spectrum of returns from 0 to 20 years and see what the returns look like if they're tax managed or if they're just taxed at the ordinary rates. So the data supports very much what you say as well.
Absolutely. Absolutely.
All right. So that brings us to this tax optimization fund that you and the team have created for Alpha Summit. And walk us through this, talk about, how the tax efficiency is engineered, how it's distinct from other tax managed solutions and you can touch on approach and where it fits into the portfolio as well.
Sure. So for us, what we were trying to focus on are ways that our clients at Alpha Summit could actually get exposure to the public equity markets in a way where, again, they could generate higher returns, but get to keep on an after-tax basis as much of that as possible. And what we thought made the most sense was to pool client capital into a fund, giving, again, our clients a single access point so that the minimums could be lower as opposed to having to find multiple managers, and then find experts within different areas within the equity markets, whether it would be long, short, managed futures, tail risk, you name it, so that the overall risk adjusted returns across a portfolio of managers would have better returns, lower volatility, and be able to characterize gains and losses in a way that were more efficient and allowed our clients to hold on to more of that capital. So our fund is a private fund for qualified purchasers that is meant to target returns similar to any other index, choose the S&P, but again, allow for that growth and for our clients to hold on to as much of those gains on an after-tax basis as possible.
All right, let's look at what is in that actual fund. We're gonna look at it at a broad-based target allocation and how you think about it, and then we'll unpack representative investments within each of these sleeves.
Sure. And this is a perfect flywheel to take a look at. For us, right, as we think about alternatives and as we think about this particular strategy, again, the goal is very attractive risk-adjusted returns within a portfolio, meant to provide returns with lower volatility, less correlation to other markets, and again, allow our clients to realize that this is a benefit to their portfolio. So like everything that we do at Alpha Summit, it's not a single asset class, it's not a single strategy, it is well diversified. And as you can see on this flywheel, about 60 to 75% of the allocation, as we think about strategies, are to those that we believe are the anchor strategies, right? They may be long short, they may be managed futures, they're doing similar things as each other, but the underlying strategies are uncorrelated to each other, again, to give more ballast to that portfolio. About 10 to 20% of the portfolio is systematic, meaning that computers are generating the buys and the sells across the portfolio allocation. Another 5 or 15% of that portfolio is meant as diversifiers. So it might be tail risk protection. It may be asymmetrical risk that a portfolio might face in times of shock, again, to provide some downside protection. And then we keep some of it in cash as well, simply because we want to have dry powder when the opportunity presents that we can allocate money to managers that are doing very well or strategies that we think will provide more diversification and the appropriate alpha to the portfolio.
That makes a lot of sense. And because it's a fund to fund, it's always good to sort of unpack or peel back some of the layers of the onion and just touch on some of the funds that are in there. Obviously, these funds solve a particular need in terms of the mandates that you've created. And perhaps you can just touch on a few of these as we go through these next few slides.
Sure. And as you can imagine, the portfolio, can change over time. Some managers will be added to the portfolio, some will be removed over time. But we think about them again as strategies that are beneficial to the portfolio. AQR is a perfect example. We think they're a tremendous shop. They do both systematic long short equity and managed futures, right? And their approach is much different than other managers that we have in the portfolio. But instead of putting clients directly into that because their minimums are so high for investors, we can put them into our portfolio, pool client capital, and clients that could not get access to them before as a one-off can get that and other strategies within the portfolio, and they can get the full benefit.
And I just want to call out too, sorry to interrupt, but I just want to call out that, I mean, that's the premise of Alpha Summit. I mean, that is, I started this entire presentation off with 6 or 7 slides about why we started Alpha Summit. And here's a perfect case. This is a great fund, but it's not applicable at all. And so the way to make it applicable for all is something that you and your team have created.
No, I appreciate that, Tyler. And it just makes a lot of sense for us. Again, we think they're one of the best managers out there. We like their strategy, but we don't want our clients to be exposed to a single manager, a single strategy. So they are part of the anchors of this fund, and we expect to continue to grow with them over time. We will continue to monitor them, do our due diligence as we did before we started allocating capital to them. but we think they are a tremendous asset to this portfolio based on their style, their track record, their history, and how they're approaching the market.
And there's three more I want to touch on, and again, we can do this in relatively quick succession. But again, I want the audience to see, some of these underlying funds that are driving this solution that you've created. So this one is the Two Sigma Beacon Fund.
Yeah, and this is a very well-known fund. Again, very high minimums for many of the investors that we speak to. They just can't access these funds. So we again look to add to the portfolio those that we think are best in breed, ones that we believe we can diligence and make sure their return stream is uncorrelated to everything else in the portfolio. So that again, you're getting the best alpha that these underlying managers can generate, but in a way where, again, you are not only increasing your returns, but you're reducing risk. Again, another wonderful systematic long-short equity manager where, again, they are targeting not only pre-tax returns, but they're also looking at this on an after-tax basis. And we believe that fits very nicely within the portfolio.
And then there's another one. I think you labeled this one as a diversifier. That's the role that this one plays. Speak about this one a little bit.
Absolutely. And when we all think about the past, we think about the financial crisis, we think about the dot-com burst, we think about exogenous impacts in the marketplace that can drive the market up or down significantly in a matter of days. This is a strategy that does very, very well when the bottom drops out, when there's a shock to the market, right? So they are not going to be generating returns that are going to be additive day by day when the market is slowly trending up or slowly trending down, but they will provide a tremendous amount of protection in those shock events. And while having that type of strategy as a one-off in your portfolio may not make a lot of sense, in a multi-strat, multi-asset class portfolio, sizing that risk properly, we believe it provides a tremendous amount of downside protection and will actually provide some upside return if other strategies or markets have a difficult time based on world events, macro events, or other things in the marketplace.
And then one more, and then remember, for everyone, we're still talking about the tax optimization fund. And so the complexity that, again, you use the example of an onion, you peel back the layers of the onion, you see more and more thought that has gone into this. And again, in order to serve the mandate of Alpha Summit writ large, which is to provide access to alternatives where perhaps either investors or their advisors who largely are listening don't normally have access to. So what's this last one before we move on to the next fund? What do we have here under this under the Brooklyn Tax Advantage Long Short Fund?
Sure, and Brooklyn is another wonderful shop. They're under the Nuveen platform. They're systematic equity. And when we all think about short-term harvestings of gains and losses to help defer taxes in a portfolio, this is another example. They are generating very attractive returns. They are harvesting losses in the short term to help defer taxes, right? And they are looking to be in a portfolio, or at least when we add them to the portfolio, to add to that risk-adjusted returns. But again, it's not just about the earnings that you get by being invested in the market. It is, from a tax perspective, how you can defer your gains in your portfolio down the line so that you get the compounding effect of the actual returns. And that's a benefit to client portfolios, not only pre-tax, but after tax.
Okay, that's great. So everything we've covered on the private side so far has had one thing in common. It's built for QPs, qualified purchasers. There's minimums, there's subscription docs, there's capital calls and K1s, which did leave a gap, right, Steve and Maz? It's really a gap that many of the people listening have to live with. And it's what we touched on earlier. It's this notion that you have clients who you think should have exposure to alternatives, but you just can't get them into an alternative under the current terms. And sometimes it's the accreditation, sometimes it's the practical aspect of just the fact that they're not going to run capital call schedules. They're not going to run a K1 cycle, they being the advisor. And rightfully so, it's a lot of work. And so we ask that same question we always ask when thinking about this: what's the client problem and what would actually solve for it? And our answer is Alt X. Steve, walk us through what we built here and why.
Sure. And Tyler, you're exactly right in terms of how we think about this for clients. Ultimately, we wanted to create something for our clients where it was a one-stop shop for all of the alternatives and private investments within their portfolio to be in a situation where we could conduct the due diligence on their behalf. We could bring investments together that, from a tax reporting perspective, was a 1099. There were no K-1s. We could provide liquidity in the form of semi-liquid quarterly redemptions, and that the minimums would be low enough so that all investors, regardless of their accreditation, could get access to that. So earlier this month, we actually launched an interval fund where the underlying portfolio is across the entire alternatives universe. These are private investments that allow the investors to not only get the higher returns that we believe private investments will allow them to access and get in terms of their portfolio returns, but also allow them to be across the board, not just private equity, not just credit, but 4 or 5 asset classes in addition to that. And I think we have a slide that will allow me to detail that a little further.
You do, and I just, I want to point out this interval fund. You were also able to secure a fantastic ticker in Alts X, and so that is the ticker indeed that we went live with, and here on the screen is what Steve's going to help us unpack.
Sure. And this is, again, it is the same concept that we've done at Alpha Summit throughout. And you've heard Maz and myself talk about this, which is about diversification, lack of correlation, and solving a problem that we were presented by our clients. And in this case, many of our clients wanted alternatives in the portfolio, but their access points were too high. They were not getting enough diversification. So what we built was an interval fund that will have more than 25 managers across various strategies, and I'll go through those in a second. They'll also have multiple asset classes, and the goal here is to provide very attractive risk-adjusted returns. Half of the returns we are targeting will be income-based for those investors who are looking for cash flow. The other half is in terms of capital appreciation. So this is meant as a one-stop investment for our investors, being able to buy a ticker, which is a registered fund in the form of an interval fund, where they can actually access and get exposure across the interval fund underlying assets in terms of the 6 you see on the board: private credit, private equity, uncorrelated alternatives that are meant not to be correlated to anything else in the portfolio, real estate credit, real estate equity, real assets, and hedge funds. And by investing in a portfolio that we have designed, it will allow them to get, we believe, better risk-adjusted returns, the alpha that the alternative space provides in a portfolio that is not only managed, but we've conducted the due diligence, and we are monitoring this on a daily basis to make sure the underlying managers are performing, the underlying asset classes are performing, and this is something that we believe should be in every portfolio.
Yeah, and this one gets really fascinating when I go to this next slide, which is really a list of some of the underlying managers or representative managers that fill these different sleeves. Pick a couple of these if you would, maybe one or two, where you're showcasing. It's where it showcases the true value of AltX.
Sure. And again, there's a lot going on this page, but one of the things that you will notice as you look around is that many of these names are names that most people have not heard of. The goal that we had to design this portfolio was not to put in the names or the managers that most of you may already have invested with in your alternatives portfolio. These were meant, again, as complements, one that would provide more diversification, and ones where we believe there's more alpha. But again, we've gone in different directions to make sure that they're also uncorrelated to everything else. And with that, I'll go to one of the middle columns, the uncorrelated alternative strategies. If you look down that page, Stonebridge Reinsurance, that is investing in the reinsurance market. Think catastrophe bonds. Be in a situation where if something were to happen, if there was a hurricane in Florida, would that have any impact in terms of what's going on in Asia or another marketplace? It would not. And it certainly would not see a tornado or a hurricane because the equity markets were going up or down, right? Continuing down that page, Partners Group royalties. These are royalties on music, on healthcare in terms of some of the the medication that people are taking. These are royalties. They're not impacted by the market. As you go out from the center, if you go to the far left, you can see various private credit managers, private equity strategies, right? Real assets and hedge funds. The goal here is to put together credit that will generate income for the investors, private equity that's going to provide a tremendous amount of growth, right? Real assets, farmland, infrastructure, and even some hedge funds that, again, will provide uncorrelated returns. So for us, the goal here is to build a portfolio with managers and strategies that will complement your portfolio. If you have other alternatives, or it can be that one-stop shop where you'll get a return based on both income as well as capital appreciation over time.
And Steve, give us a sense, just as you're looking at allocating from Alpha Summit, but give us a sense if I were an advisor and I had a client that wanted to get access to managers like these, what would typically be required to get access?
Sure. Depending on the strategy, depending on the manager, it could be $5 or $10 million for certain managers, right? Other ones might have lower minimums. So unless you're putting to work 10 or $20 million, you're certainly not going to be able to create a diversified portfolio like this. And even if you could, most of the folks that we speak to certainly don't have the time to do the due diligence, to track down the managers, to monitor them over time, so that for our clients and for those that are looking to get into the portfolio, we've done the heavy lifting for you, not only to set up the portfolio and to diligence the managers, but on an ongoing basis so that the managers are still doing down the road, whether it be a year, 2 years, or 5 years down the road. If they're not performing as expected, we might remove them from the portfolio. Or if they're in a situation where they're outperforming, we might increase the allocation. So it's an ongoing responsibility that we're taking on behalf of our clients, and we're excited to do it.
And so for $1,000, you're basically getting access to what would, I mean, if you extrapolate the math, if it's 5 million to get into each one of these, you're upwards of $100 million. So for $1,000, you're getting what would otherwise be requiring clients $100 million or so, just to sort of put an emphasis on that. Is that fair to say?
Absolutely. And our view is, if an investor wants to dip their toes with whatever dollar amount they want starting at the minimum, they'll quickly add to that over time as they see the returns and as the portfolio performs as we expect it to do.
Yeah. All right. So, I think, we touched on some really important things. We touched on what the difference of Alpha Summit is. And I just want to go back to this because as you probably heard from both Maz's comments and Steve's comments, we're not the traditional asset manager here. We're not developing products for product's sake. We're not developing products to try to find the buyers. We already have the buyers. We already know who wants these solutions, and we're developing those solutions based on what we've experienced as investors in the private wealth space, and now offering those through the Alpha Summit platform. And so, when I do want to sort of, again, like I said, bring us back to where we all started here. And I want to, I want everyone to think about, their book of business, how they access these different solutions, and, where they would find a solution like we just talked about. I mean, AltX is just, I know we just talked about it, but again, if you just use that as an example, you would need hundreds of millions of dollars to access those alternative investment solutions. And we're able to deliver that for $1,000. And so, as we talk about how advisors are using Alpha Summit, that's really a concept of how an advisor starts with us. And there's a few different doors, and none of them really require you to move, blocks of your book. And as is the case with all client situations, it starts with the client need. And we think because we have a front seat or a front row seat at, what all clients need through our exposure at SteelPeak Wealth, Alpha Summit has delivered solutions that address those needs. So what I would recommend in my advice is to pick a client situation where you don't have an existing solution. You don't know of something that's out on the marketplace, and let's have a conversation about it. We have a team of folks that can speak to you about these different solutions that you heard. And we didn't even cover, several of them. And so there might be some that we didn't talk about today that could be a good solution. And, I think that's that's the best starting point. So if you think of a client's needs being income, taxes, access to alternatives, retirement planning, I think that's pretty much covered your entire book. I think every one of your clients has a special need around all those areas. And if, alts can play a role in it, we'd love to be a part of it. So with that, I know we have received some questions before we started, and I've got some questions lined up. And so I want to bring Maz back. And I know, Steve, you're still here. So some of the questions, I think are just around this notion of objections and, what are some of the objections you hear about investing in Alpha Summit specifically? I know there's objections around alternatives. I think, Maz, you addressed that very well in your comments, but what about Alpha Summit as, someone who's invested on behalf of ultra high net worth individuals? You get pitched a solution, probably hourly, or I mean, certainly daily, but maybe even hourly of other investment managers out there. Why should someone pick up the phone or reply to an email from us about Alpha Summit?
Tyler, that's an excellent question, but openly, I think you've answered it a few times throughout this presentation, which is the foundation, the catalyst behind Alpha Summit is existing client needs. We realized what clients were looking for and expecting, and we built a platform based on that. So it was the needs, the wants, the expectations of the end client, and what we can do to achieve those goals and objectives.
Yeah, that's fair. And shifting our thought a little bit about just sort of the overview of Alpha Summit and the objections and again the reasons why someone might do business with us, oftentimes comes up the notion of fees, and we did have some commentary on it, but while you're still here, Maz, maybe you can just touch on this, what the fees look like and the revenue sharing, if there are any revenue sharing or platform fees on the underlying managers, particularly in Alts X.
Yeah, again, a very meaningful question. I once heard someone say fees are a problem in the absence of value. And that makes a lot of sense to me. Specifically, when you're talking about alternatives, any type of alternative, traditional private equity, traditional private debt, obviously the interval fund we've produced. These are not ETFs, right? They're very complex, very laborious strategies, very unique strategies, and as Steve correctly added, strategies that A, are oftentimes not available to clients, or B, strategies that are just simply closed, but we have access to them based on the relationships we've built over the last 25 years. So this is one of those instances that you kind of get what you pay for. The fees aren't exorbitant. They're in line with what you would expect with alternatives. But again, they're not ETFs. So one cannot expect to get these types of unique strategies and pay, 10 basis points as you would when you're buying, an ETF as an example.
Yeah, that's helpful. Steve, you talked about several different managers and representative managers that are in the underlying funds. One question is, what happens if one of those managers underperforms or has an issue? What's the process for removing them? Just give us a little sense that of how that's done. Not to focus on the negative, but certainly, as an investor or putting our clients into these funds, we would want to know some of these answers.
Sure. And it's a great question. And again, it goes to our background in terms of how we built these products, right? So when we are looking at managers, we not only do the due diligence going in, but once we like what the manager is doing operationally, as well as from an execution standpoint, we bring it to our investment committee, and we vote as a team. We will do the same thing if a manager is underperforming. And if we think that they are underperforming, we'll vote as a team to remove those managers. But keep in mind, when we're measuring a manager's performance, right, most people just think about what is their absolute return. For us, it's not just absolute return, it's what is their purpose within the portfolio. So if their purpose is to generate uncorrelated returns, there are certain managers and strategies that we would expect to underperform the markets depending on the market's movements, right? A volatility manager, as I referenced earlier, we would expect them to not do well in a very quiet, slow-moving, trending market, right? So what would cause us more likely to remove them would be if the markets spike. That's when we would expect them to make money. And in that environment, they do not make money, they lose money. So it's about, are the managers consistent? Is their style drift? And is the purpose of their addition to the portfolio still there? That will impact our decision. But we vote them in as a team, and we will vote them out as a team if we don't like their performance.
That's helpful. Okay, so I know we're coming up on the top of the hour. I've got one more question, and then we'll end with a conclusion. But I know we just launched Alt X, and so that one is essentially evergreen at this moment. But are there other capacity constraints, or are there time bound elements where some of these strategies might close, Steve?
Yeah, no, that's a great point, Tyler. So all the strategies that we mentioned are open at the moment, other than our sports fund, which has a time constraint. We will be closing that fund to new capital at the end of this year. The portfolio has done very well. When investors come in, they come in at cost. And we want to make sure that those investors who came on early on are not diluted by allowing too much capital to come in the door. So based on the tailwinds that we've seen, and the fact that we have overcome the initial J curve very quickly, and the portfolio is up a lot in terms of multiples, we will stop accepting capital into goal line growth, which is the sports fund, at the end of this calendar year.
Okay, that's helpful. And you touched on something that I know will be an important sort of byproduct of what people want to hear more about. And I want to make the offer to anybody listening or watching. If they want to do a deeper dive, whether they want to do a call, they want to see a fact sheet, or they want a diligence package, we can get them set up. And so we'll be sending out our contact information, and it'll be available in the presentation as well. And know that our team, our Alpha Summit team, is well versed in speaking with advisors just like you about who these solutions are meant for. We're not here leading with a product. We're, again, leading with a solution. I know it's trite. I know you've heard it from other investment managers, but it is the fundamental core of what we've built at Alpha Summit. And our team is very well versed sitting down with you to the extent that you're open to it, looking at your book of business, looking at your clientele, and identifying where solutions that we have that can solve for things that you don't otherwise have access to. And so I'd invite you to do that. I'd invite you to take the time to think through your book of business, think through some of the things that we talked about here and how they might apply to the challenges that your clients face every day. Because we know this is not an easy world, and we want to be the straightforward, simple solution for all these different areas within your client's wealth. And so with that, we have come to the top of the hour. I want to be respectful of everybody's time. If you have additional questions or follow-up, again, we stand ready to help. But thank you for participating, and thank you especially to Maz and Steve for sharing everything about Alpha Summit.
Thank you, John.
Thank you.